Technical analysis is a powerful approach to understanding stock market movements. It focuses on reading stock charts to predict future price movements based on historical patterns. Unlike fundamental analysis that looks at company financials, technical analysis studies price action, trends, and patterns that emerge on charts. This method is used by traders and investors worldwide to make informed decisions about when to buy or sell stocks. Technical analysis is a method of predicting future price movements by analyzing historical price patterns and trading volume. The core idea is that all available information about a stock is already reflected in its price. By studying how prices have moved in the past, technical analysts believe they can identify patterns that tend to repeat, giving clues about where prices might go next. This approach relies on charts and mathematical indicators rather than company reports or economic data. Technical analysis rests on three fundamental principles. First, price reflects all available information. This means everything known about a stock, from earnings reports to market sentiment, is already captured in its current price. Second, prices move in trends. Stocks don't move randomly but tend to follow directional patterns over time. Third, history tends to repeat itself. Human psychology drives market behavior, and similar situations often produce similar price patterns. Understanding these principles helps explain why technical analysis works. There are three main types of charts used in technical analysis. Line charts are the simplest, connecting closing prices over time to show the overall trend. Bar charts display more information, showing the open, high, low, and close prices for each period. Candlestick charts are the most popular among traders because they provide the same information as bar charts, but in a more visual format that makes it easier to spot patterns. Each chart type has its uses, but candlesticks have become the standard for most traders. Candlesticks are visual representations of price movement during a specific time period. Each candlestick shows four key prices: the open, close, high, and low. A green or white candlestick means the closing price was higher than the opening price, indicating bullish or upward movement. A red or black candlestick means the closing price was lower than the opening price, showing bearish or downward movement. The rectangular body shows the range between open and close, while the thin lines called wicks show the highest and lowest prices reached during that period. Chart patterns are formations that appear on price charts and suggest what might happen next. They fall into two categories. Reversal patterns indicate a trend is about to change direction. These include head and shoulders, double tops and bottoms, and triple tops and bottoms. Continuation patterns suggest the current trend will continue after a brief pause. These include triangles, flags, and pennants, and rectangles. Recognizing these patterns helps traders anticipate future price movements and make better trading decisions. Support and resistance are critical concepts in technical analysis. Support is a price level where buying pressure is strong enough to prevent the price from falling further. Think of it as a floor that holds the price up. Resistance is a price level where selling pressure is strong enough to prevent the price from rising further. Think of it as a ceiling that holds the price down. These levels are created by supply and demand dynamics and often occur at psychologically significant prices. When a stock breaks through support or resistance, it can signal a major move. Trends describe the general direction of price movement over time. An uptrend is characterized by higher highs and higher lows, meaning the stock is consistently moving upward. A downtrend shows lower highs and lower lows, indicating consistent downward movement. A sideways or horizontal trend means the price is moving within a range without a clear direction up or down. Identifying the current trend is essential because one of the golden rules of trading is to trade with the trend, not against it. Technical indicators are mathematical calculations based on price and volume data that help confirm what charts are showing. They fall into different categories. Trend indicators like moving averages, MACD, and a DX help identify the direction and strength of trends. Momentum indicators like RSI, Stochastic, and CCI measure the speed and strength of price movements, helping identify when a stock is overbought or oversold. Using multiple indicators together provides more reliable signals than relying on just one. Let's recap the essential points. Charts reveal price behavior and market psychology, giving insight into how traders and investors are thinking. Patterns help identify potential price movements before they happen. Support and resistance define key price levels where buying or selling pressure is concentrated. Indicators confirm trends and momentum, providing additional evidence for trading decisions. Most importantly, combine multiple tools for better analysis. No single indicator or pattern is perfect, but using several together increases accuracy and confidence in trading decisions.
If you like this video, hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.